Hey everybody, Brian here from quantlabs.net. Just wanted to go over with you that's been in my mind the last few days, despite all the recent quote-unquote trading videos I've been putting up. This is a really critical one, and you want to know you're not wasting your time on this research type of stuff. So one of the big things I'm trying to determine, is it worth more while to invest into direct stocks, or is it better just to do pure ETFs for, let's call them, hot sectors? Now, I was in a meetup last night with a bunch of traders, about 30. A good chunk of them are playing in ETFs, less and less of stock. More newbies are moving into ETFs as well, so I know I'm on the right track. But I've also kept hearing statistically that stocks do better. Now, for those that may not be able to devote as much time into this, which is fair, ETFs is definitely the better way. I've gone over numerous advantages of ETFs. But the real debate comes down to, do you get a better return with stocks versus ETFs? So I'm going to show you the answer right here, right now, and this is the reason, and I'm going to give the conclusion in a little bit. But I'm just going to rewind what I've been doing. Today I've done a new scan. I've mentioned this category before. It's not a stellar sector, but it still makes the point of, do you put money into an ETF, or do you put it into actual direct stock and stock only? So here's the results of this scan. As you know, right now, I just call this the BS factor. Two big things I go after are market cap and EPS. EPS is only, earnings price per share, is only used for guidance on how the company that it is issuing it feels about their outlook over the next quarter, next year. Now, it's really important to me that I get all three figures of both EPS current, next year, and next quarter. A lot of companies don't put EPS at all, like here, and some don't even put EPS for next quarter, next year, which means they have no confidence in their outlook. So why play it? The other thing I'm looking for is I want a market cap of at least $1 billion. Simple enough. All right. So what I've done is I've identified probably the top three, which this one is CP, Canadian Pacific. Also, the other two I'm looking at are Norfolk Southern Corporation, NSC, and Union Pacific. So that's what we're determining, the top three, based upon the EPS alone. Nothing else, fundamental stuff. So when you look at the EPS, let me just see here. Okay, so there's some talk on this site, ETF database, on what's the best ETF, or sorry, the best ETF for it, which came down to this one, iShares Dow Jones Transportation Average Index. And that's a ETF, IYT. So if you come to Yahoo Finance, you'll find I've included that ETF right here, IYT, which is blue. And no matter how you look at it, and I've only looked at it for the last, looks like this is a one-day chart. Okay, so intraday. You still get better performance, better performance with over the S&P 500, better performance in the CP, better performance in UMP and NSC. Okay, so let's check out the 5-day. I've not looked at this yet. So our blue is here, but that's over 5 days. Now let's take a look at 1 month. We see the ETF is still averaging, but it's underperforming. Now this is just a random scan. I'm just trying to see where we're at. Okay, let's look at a 3 month. So the ETF is doing average. So let's do a 6 month. It's still doing okay, but when you look at the GSP, it's still underperforming. But we're not here to, let me just take out this. The whole point is we're just watching the overall performance of an ETF versus stock. That's what we're talking about. This could be a bad sector to look at, and probably it is. But you can see in blue that the ETF is still outperforming the stocks, these top three at the time, which may be the best of the bunch, at least currently. So if I look at year to date, it's still outperforming it. So you have this one here of CP, which is outperforming, but it's been clearly, this is the problem with stock. It's too volatile. That's a nice thing about ETF. It sort of smooths out that average. And you don't have to do less trading, and you can just really set and forget about it. But let's start now looking at 1 year. So right now, there's been one that's been doing pretty good, the UNP, and the difference is roughly, let's see here, 11 to roughly, it's almost double the performance. But overall, the ETF has still done fairly well against these top three, but if you averaged it out, I think the ETF will still perform better. And let's look at maybe a 5-year. So the IYT, so you still get some better performance out of the stock, out of these two. So it depends on how you look at it. If you're trying to set and forget, I would probably maybe go in the ETF. It just depends upon your ETFs, but I would think it still might be a better route, but just depends. But just in the last year, as I said, the ETF is still doing pretty well compared to a bunch of them. But that's what we're trying to do, is we're just trying to play the hot sectors. But overall, I personally think that you're just better off to play the ETF itself. You get better performance that way if you're just going to set and forget. So that's my conclusion is, for now, I'm just going to play the hot ETF sectors and not worry about individual stocks. So that's my conclusion. I just want to put this video together just to give you a chart of a random sector, and I've shown some other past videos that show clearly that the ETFs have been kind of outperforming. Because the other good thing is that ETF managers will always do the same thing you're going to do anyways individually. Select the hotter stocks. So they'll try to beat some of these stocks. But for just setting and forget, I do think ETF is the better way. Just so you know. Hopefully this will help you out later.